Welcome to you guys both. Ian, I'll start with you. I'll call you in the dovish camp. You're worried about growth. So tell us where you stand right now.
I'm worried about it, but I'm not panicked about it. I kind of think that, getting a recession, the dreaded mild recession, is not a crazy idea. I think that getting a really bad, severe disaster recession is much less likely. And I think there's a reasonable chance of avoiding both of them. I mean, I think, if we get to the middle of the year or even the end of the year and we're looking back and saying, hey, the economy managed to bumble along without falling into any sort of recession at all, that wouldn't massively surprise me. I think what would surprise me would be either the disaster scenario or the 5% growth scenario. Those, I think, are really pretty unlikely. I mean, the private sector's finances are under stress from the Fed, but they start off in reasonable shape. So if you think that a recession or a cyclical downturn is proportional to how aggressive the Fed's been and the state of the private sector's finances, well, the Fed's been very aggressive, right, but the private sector's finances are okay. So bumbling through seems a reasonable starting point. But it could tip either way.
So first thing to mention, I don't really, to me, it's not so much about does it happen in the calendar year. It's just how big is this looming thing going to be? How big is the iceberg, right? And it's interesting to me, and that's why I wanted to highlight it, that we have bank CEOs talking about, as if it's a given, a mild recession. That's not necessarily consistent with what the yield curves are telling us. I mean, they're telling us a major iceberg is coming.
Yeah. They are. And this is a real problem for forecasters now and for investors because we've got a bunch of very mixed signals. And if you look at housing, total disaster area. You look at those ISM surveys, they're really alarming. The NFIB small business survey tells a similar story, really pretty grim. But then if you look at consumption in the fourth quarter, it's going to be 3% plus, probably. Consumer confidence numbers today up quite strongly. Big jump in people's view of the current economy. People getting a lot less worried about inflation. And the consumer is nearly 70% of the economy. Capital spending intentions are weak, but they're not terrible, and they look like they've bottomed out. So there's a real big bunch of conflicting indicators, and I think it's really important for everyone to keep their mind open as to where we could go. This has been a very unusual economy now for almost 3 years. Since COVID struck, all the old rules are out the window. All the things that used to be reliable indicators now sometimes are, sometimes aren't. We just don't know.
Sure.
And it's easy to be blindsided. We've been blindsided by inflation, for sure. Maybe this year we get blindsided by growth. It's really difficult.
And Steve, the worst data point we got today, 5 to 10 year inflation expectations, up to 3% for the consumer. This is after the gasoline. But here's the point. You and I know.
Freaked out by that one.
The Fed's obsessed. They're obsessed with inflation. They're going to look at that and go, we can't back off now. Inflation's just becoming entrenched. We don't care about the yield curve.
I think their story has been that inflation expectations are relatively under control, and I think they're going to stick with it with a small increase on the 5 and 10, at least for now. But I think Ian's on to what, I don't know. I would make more of it than you do, Ian. From the Federal Reserve standpoint, the big story has been 400 basis points of tightening and an economy that is strengthening as we end the year. I think when it comes to the Federal Reserve, I think they're looking at that. We had Bullard talk about it yesterday. Now, the kind way that they process this is they say, hey, this is great. We can fight inflation, raise rates, and not hurt a lot of people. On the other hand, if they, under their formula that they see the economy, they have to bring growth down below potential to create slack in the economy. And by the way, there's reason to think potential might be a little bit lower than it otherwise was before. And so that would mean from their standpoint, they have more work to do. So this good news on the economy, the spending numbers that we have, the employment numbers we have, I think are key, I think is bad news for a Federal Reserve that's trying to fight inflation.
Go. Ian's just like, yeah, I agree. Ian, sorry, your delay's throwing me off. Go ahead. What were you going to say?
Yeah, sorry. So of those rate hikes that they did last year, 275 basis points came in the second half of the year. And I think it's very likely that hardly any of that has filtered through into the economy already, and yet inflation is rolling over right now. So by the time those 275 basis points work through, that's going to be putting downward pressure on an economy which has already moved into the disinflationary phase. And it's certainly true, payroll growth is still pretty strong, but I think part of that is just the tail end of the post-COVID catch-up hiring that began back in the summer of 21. And that's really fading away now. And as it disappears, we'll be left only with the cyclical component, and that cyclical component is going to come under pressure from the lagged effect of the rate hikes. And some people at the Fed are talking about this, the lags and the cumulative tightening they've done so far. And so the question is clearly being asked about whether maybe they've done enough or nearly enough. I mean, I totally agree they're going to hike again on February 1, but I do think when they sit down in March, if we've had another couple of CPI reports which are pretty good, and we've seen payroll growth softening and wage growth continues to soften as well, I think markets are going to be saying to the Fed, hey, do you really need to keep going at all any further? You know, the skepticism among investors, I think, is really building now as to whether the Fed's ever going to get to this 5% plus that they're talking about. And
I have a chart for that.
If they do, how long they're going to stay there.